Hello everyone, nice to meet you all. Today I've invited a special guest right next to me. Would you mind just introducing a little bit about yourself and the fund and what you guys have been doing in the last sort of 12 months and so?
Yeah, thanks for having me, Johnny. My name's Andrew Mitchell. I'm co-founder of Ophir Asset Management. We manage over $1 billion of assets for high net worth investors, family offices, and also some superannuation funds. We invest in small cap companies, both in Australia and around the world. And when I say a small cap company, I'm talking about a company with a valuation on a stock exchange of 2 to 300 million will go up to around 5, 6, 7, $8 billion in size. So some quite sizable businesses. We're traveling around the world all the time, doing lots of phone calls around the world and Australia, looking for some great companies that are going to do very well in the years to come.
Fantastic, thank you. I've got some questions I want to ask, and I guess how you sort of currently position your fund at the moment. So we've gone through a period of obviously huge volatility within the market, and I think many of our clients also wanted to sort of understand from a fund manager's perspective, what do you think the opportunity lies in sort of next to 6 to 12 months, and I guess with the global focus that you have, which part of the markets that would you focus within your fund in terms of sector allocation, and so forth, and some of the ideas that you've been focusing on?
So we're in a really interesting situation. In terms of fiscal stimulus, that's government spending. Governments around the world are spending a huge amount of money to try and prop up economies. But at the same time, what is really interesting is what the central banks are doing. They're lowering interest rates and they're flooding economies with cash. Now what that means is there's not much incentive to keep your money in a bank account. Companies and people alike should be investing. Well, that's what the central banks want you to do. And a lot of this money is finding its way into the share market, and it's propping up valuations. So you're seeing share prices go higher. Now what we do is we look for businesses that are going to grow really no matter what. So think of a company in a market. So one industry that we've invested in has been infant formula. Chinese parents or mothers who are buying infant formula for their children are not going to stop buying infant formula for their children because of COVID. They're going to continue, and they'll buy the premium brands. So that's an instance of an industry that's going to be fine through this period and is going to continue to grow. So we're looking for those sort of companies that perform well no matter what the economic environment is.
I think the recent sort of focus from a private investor's perspective, who's now started to look at the market more actively, is some of those tech stocks that's driven the market quite high. And I think one of the sector within ASX we could choose is the buy now, pay later type of sectors. What are your thoughts on that? Is it a good time for you to continue to hold? Is the fund still holding Afterpay, or not just Afterpay, but in the sector as a whole? Do you see this growth to continue on further?
Yeah, so we were a very early investor in Afterpay, Johnny, and we've developed an ecosystem in terms of the way that we monitor how this business is going and the real buy now, pay later space. We've sold a lot of Afterpay stock, but when you buy it at a couple of dollars a share and it's now $70 a share, you've made a lot of money over that time. But typically a stock like that in our fund would only be 4% of the total. As it goes higher, you need to keep selling it. What we've observed with Afterpay was March was the real test. We were hit by COVID. Afterpay had never been through a tough period before, but they were able to adjust. And they adjusted by, you had to pay your first instalment up front. They also cut back on who would get buy now, pay later access, depending on what products that you were purchasing, because they can monitor the quality, who's most likely to pay the money back. So they cut back on the more risky. Now, it went through that with flying colours, and I think what's happened post that is that the company seems to be willing to take on a little bit more risk. We've seen in terms of their approval. We think that they're approving more, and the growth has really accelerated as people around the world have been buying more online. They've been using Afterpay, and its adoption is occurring at an accelerating rate around the world, and it's still growing in Australia as well in terms of its oldest market. So we think the future's rosy. The valuation is tough. Now, we've sold a lot, so we've got a smaller weight in it now, and we'll watch it because this valuation is really stretched.
Right, okay. And I guess follow on to that. So the pre-COVID and almost like post-COVID, and as you said, the company with good values, good growth, with perspective, and companies who can generate good revenue despite the current circumstances. Obviously, there seems to be a structural shift in terms of going. A lot of them are going offline to online. Is that kind of a continued theme that you think is going to continue on for the next 10 years in terms of the company you tend to choose to invest? How does that?
So, like retailers,
for example, retailers, they struggle
100%.
longer.
So, one of the investments we have in our global fund is a company called HelloFresh. And HelloFresh is listed in Germany. Groceries before COVID, there was about 3% that were bought online. We now think it's probably closer to 5-6% that's online. But if you compare to other categories where you've got 20% penetration online, there's a long runway for adoption to go online. And what COVID has done is it's forced people who are living from their armchair to learn how to shop online. So we think we've actually gone several years forward in the adoption. When we speak to these companies that have got online businesses, they're seeing new cohorts coming in who are a different demographic. But after, in Australia at least, we've been able to go back into the workforce and go back to semi-normal lives, these people are still using online, i.e. they like the experience and so they will do it again. So we think that online penetration has really improved, and we will see more and more industries just go this way.
Yeah, okay. And I guess the good sort of question that a lot of our predominant Asian clients would also understand and want to appreciate is that there's been, I wouldn't say a debate, but I think our preference, some of the Asian clients, has been always traditionally in traditional assets like property. It's been a very good play for them. And obviously share market in Australia also does exist, and it is a very developed market, I guess, in comparison to some of the Asian emerging markets. The question is, I guess, from a client perspective, would that be a cons and pros between shares and property that you can think of that personally as well, just in a general perspective? What will be your preferred asset allocation?
Well, for me, I know shares. I don't own a house.
That's right.
Maybe I will in the future, but I'll put my money in shares because I know what I'm dealing with. I have got no issue with property as an asset class, but I like diversification. Like our funds have 30 different stocks that are from a range of different industries. From my personal standpoint, I understand shares, but if somebody's looking for their own portfolio, I think it's a good idea to be diversified.
Absolutely.
The great thing about shares is you can find an Afterpay where you buy a stock at $2 and it's now $70. I know in A2 Milk we bought that at 50 cents and it's now $20. So we've made 40 times our it's probably even more than that. We've made a huge amount of money on both of those stocks. It would be pretty hard to do that in property. But you need to, I think, find professionals or at least get professional help to be able to spot these companies early.
I agree.
And that's what we do, and there's lots of other good providers out there who can help people find these companies in the market and have the ability to have a stock like an A2 Milk that goes up 40 times.
I agree. Thank you for that. I guess probably just a quick follow-up question thereafter is that obviously there's been talks about the government stimulus been supporting the economy quite a lot, and there's talks about in September, JobKeeper, JobSeeker might pull off, and that's going to create this huge hole in the economy. There's all those concerns here. Would you mind sharing your 2 cents and opinion on that and how you see that playing out?
The fiscal cliff, as it's sort of termed in September when JobKeeper, JobSeeker comes off, I don't think the Australian government would ever want to do that, create a fiscal cliff. We know that they've got $60 billion in savings, or at least that they saved that was in the original budget that Treasury came up with. Our view is that they will extend that $60 billion to help people with a JobKeeper 2.0, if you like. They'll means test. I know it was done on just sort of in terms of March sales falling 30%. I think there'll be a lot of companies that will be forced to that won't get the benefit of JobKeeper anymore because they don't need it. And they'll try and take that $60 billion out to Christmas and beyond. We're not going to step back from supporting the economy. We won't go this far to just abandon it. So I think the government's going to act as a backstop in Australia for some time yet.
Okay, thank you. And just another follow through to that. What's coming ahead, obviously, is we've got a US election happening at the moment. There's campaigns already started, and there's a lot of talks about that. And I think people want to understand, from a fund manager's perspective, how do you position some events like that that's coming up shortly soon, relatively soon?
Well, I think you have to think about the biggest, I guess, when we're watching this, there's a lot of different outcomes that can occur in terms of control of the Senate and the likes. But for us in the lead up, I think this is the most important thing to focus on. If we've done analysis where you look at the last 100 years of US elections, if the share market was up in the 3 months leading up to the election, the presiding president won the election. If it was down, they lost. So it's obviously there's not a huge amount of data points, but there's still quite a few there. This won't be lost on President Trump. We think there is a huge amount of government spending that is going to come in the lead up to this election. And he will be doing everything possible, even though the Federal Reserve is independent, to make sure that they support the economy leading up. And so just look out for more fiscal stimulus coming from Trump leading up to that election. He wants the share market to go up because he wants to get re-elected. Yes. So he's going to put as much money as he possibly can out into the economy.
Fantastic. Lastly, a question for you, if you don't mind.
Yeah, no worries.
You're a global asset manager. You love to look at emerging markets or some of these opportunities. You want to find what's going to be the next Afterpay or something else thereafter. So you'll be continually studying the market. I'm curious to know which sort of geographic perspective, which of the countries that is in your radar that you're looking more closely than ever before, and or what are the reasons why?
So we don't look at developing economies. So we're not so much in China and the developing East Asia. We look at the US, Western Europe, Japan, the UK, and Canada. We're seeing a huge amount of disruption. The old world of companies are being disrupted all the time. I think 100 years ago, if you were in the top 500 companies in the US, you stayed there for 60 years. In the 60s, that fell to around 30 years, and it's now down to 13, 14 years. That's the pace of disruption. Now, who's doing the disruption? They're the smartest people who are coming out of the best universities in the world. And the US is where the smartest, brightest people from around the world go to university. And so we think that you're still going to see this technology really be driven out of the US. And it comes out of a lot of the universities. People go to Stanford.
That's right, Harvard.
They learn, they get educated, really smart. They then hit the streets and they are entrepreneurs with some fantastic ideas. A lot of them fail, but some of them don't, and they take a lot of market share from the incumbent. So we're really focusing still on the US for these sort of businesses that are the next game changers, the next Afterpays, if you like.
Thank you very much for spending your time, a precious time, to visit. Obviously, you're currently today in Brisbane, but we'd love to have you on again down in the future. I did hear that your firm is also very multicultural in terms of your staff members as well. So
Koreans and Chinese.
That's right. So we'd love to meet them down the track, but I appreciate your time and thank you for your insights.
Thanks very much.